Well, good morning, everyone, from here in London. Today, I'm delighted to introduce another FS Club webinar, What's the Gap? Basis Chance in the Age of Parametric Insurance. And presenting today is Henri Winand, who is the CEO. Now, you'll know me. I'm Michael Mainelli. I'm one of the directors of Zien. And it really is a privilege to be able to introduce these various webinars that we're holding. And I can only really do so because of the generosity of our sponsors who allow us to range widely and freely across technology, economics, and finance. So it really is a genuine pleasure to be here. I will just introduce you briefly to today's agenda, which is very straightforwardly, I'm going to get out of the way and let you hear from the expert as quickly as possible. Dr. Winand will be speaking for approximately 20 to 25 minutes, and then we will go into a question and answer session. Probably the most important thing for me to ask you is to please send questions to me via the GoToWebinar question facility, and I will feed them into the conversation with Henri. If you email me or text me or WhatsApp me or any of the various thousands of ways of getting hold of me, that's very kind. But I'm here with you at the moment, so I won't get them till afterwards. So please do send the questions through the GoToWebinar facility. And finally, a word of warning for those of you. One of the great things about FS Club is you're very fast on the buzzers. Henri has three polls actually, of questions he'd like to ask you. So with that, you've got all the details online. The slides will be posted afterwards, and the recording will be up in a couple of days. And I would basically like to say, Henri, the floor is yours.
Thank you, Michael, and thank you to you and the FS Club for inviting me today. It's a real pleasure to be here. So what's the gap? And really basis chance, but of course the other side is basis risk and how to look at that through the lens of parametric insurance. And before that, just a very quick introduction. I'm Henri Winand, the CEO and co-founder of AkinovA. AkinovA is a marketplace. It's unique in that it is neutral, regulated, and digital-first marketplace, and it operates at the intersection between capital market and insurance. And you'll see that theme throughout the presentation as well. And it's really to transfer and trade insurance risk, and it's where capital can meet insurance, reinsurance, and insurance-linked securities risk directly within a regulated environment, but animated by data-driven brokers and powered by insights from third-party data analytics providers. Next slide. So if you look at some of the challenges of to the insurance industry in general, is that certainly if you look at this chart from McKinsey over the last year or thereabouts, the returns, the shareholder returns compared with other industry segments hasn't been the most stellar. Now, some people would argue that as the market is hardening and there is some evidence of that, and premium therefore can go up, profitability will increase. But at this point in time, it continues to be a challenge. Next slide. So what I'm going to ask you is to rank what do you think are the biggest issues in reinsurance. And some would say maybe there are no issues, but let's pick a few of those. Is it low interest rate? Is it profitability, low growth? Is it the perceived product value proposition and so forth? And so I would ask you to take a view as to what you think the issues are. Next slide.
So folks, if you would just briefly summarize what you think is there. As ever, FS Club members very quick with their decision making. We're nearly up to half the audience having voted. Now we're well past that. And I will close the poll in just a few seconds as we're up to well over 80% now, 90%. Great. So we'll share the results with you. So pretty strongly on there about the different risks accelerating a growing insurance and reinsurance gap, Henri. Back to you.
So that's fantastic, actually. So thank you for the audience to be so prompt on the button there. So if we look at the next slide, insurance in traditionally you would think it's actually reasonably simple. I'm going to make sure that I've got my premium exceeding my losses or my claims, and then of course I'll have an investment income. But of course the investment income is challenged, and you can see that with a very low interest rates compared to what has been happening historically. Next slide. And actually, it is not just the underwriting, so picking the right risk that's important, which is reflected in the combined ratio there, but it's also the loss adjustment expenses, which has been creeping up over the last, together with the industry loss over the last 10 years. And that is a traditional insurance policy, an indemnity policy, indemnifies you for the losses you've actually incurred. And of course, you need someone, typically a loss adjuster, to go and check what you've said you've lost and say whether or not it was true. And as the industry tries to digitize that process, of course, is to reduce the cost, but so far that hasn't fed through. And growth is not easy. This is an industry which typically and historically, premium growth has been in lockstep with GDP growth. And then the final thing, in general, for the existing indemnity and the existing industry structure, actually supply of capital has been plentiful, and therefore it's been difficult to increase prices as well. Next slide. Now, there is a tremendous opportunity for the industry as a whole to grow substantially, is because risks have become more dynamic than ever. So if today you have a focus of the industry largely on tangible assets, and the tangible assets, let's say a building, hopefully the value of that building doesn't change the whole day long, and therefore, and also it has a physical presence, and therefore there's a recourse to that. But if you start to think about cyber risk, and if you start to think about, for instance, intangible assets, the intangible assets for corporates are basically valued in the markets the whole day long in stock exchanges. And of course, the variability of those combined, for instance, with cyber risk, when you can have a cyber storm 24/7, 365, not just like normal storms that you would have, which are seasonal. Therefore, the variability and the dynamism of those risks requires essentially a transfer mechanism, but also the right capacity. Next slide. And some of these risks are also coming together and aggregating in such a way that they become more systemic. Next slide. Well, if you remember, for instance, 737 MAX 8, which is just coming back into service now, it was a piece of software and a small piece of hardware deployed across an entire fleet, which basically stopped a chunk of operation for a very large Boeing, a large manufacturer. Boeing created crashes and a whole load of turmoil associated with that. And the more you have, if you think about all of us have PCs operating on mostly the same operating system, you have a potential for aggregation, but also there's a potential for looking at diversification very differently. If you think about property catastrophe, of course, climate resilience has continued to increase and the protection gap has continued to increase. So the insured versus uninsured gap has continued to increase. And if you think about cyber risk, that is something that is gathering pace. And as was actually noted over the last few days by the CEO of Marsh, one of the largest brokers in the world, before COVID-19, maybe cyber risk wasn't your biggest exposure. Post COVID-19, it certainly is. And then there is a small issue at there, which is there's about $26 trillion worth of corporate assets, which are uninsured, which are intangible assets. Next slide. Now, this one is quite an important one, which is the perceived or the real information gap between the insured, so the cover buyer, if I can put it like this, or the risk seller, and then the capital provider on the other side. And that information gap is a business dictionary gap, insofar as insurance uses quite a lot of jargon, like most industries, but also the availability of the insurance and the availability of the data and the availability of the information and the interpretation of the wording means that the cost of analyzing and putting capital to work against an insurance contract requires some work. Next slide. And if you look at it from the protection seller, whether it's the capital market or an insurer or reinsurer, particularly those who are more on the capital markets end, they have far more information available in terms of reports written about companies, but also they have, for the last certainly 25 years, started to talk directly talking to insurance or insurance risk to insurance-linked securities. And that's a change because traditionally, the way an investor would participate is to participate and buy some stock, for instance, in an insurance company or reinsurance company, and then let them to do the rest of the work. Now you can basically take a position in an ILS fund, then you have direct exposure. And we see that continue to take place. And I think the really important thing for the capital markets is that they're looking for two things: yield that is decorrelated from capital markets movement. And insurance certainly can offer that. Next slide. So what's the proposition? Then often people will say, and particularly Millennium, one of the charts on the bottom right-hand side, would say that the perceived value of the insurance product is actually quite low. And if you look at the value proposition or worth of $1 of premium and the separation between expenses, claims, and so forth, you find that profitability can be hard to get. And the insurance gap continues to be there. And one of the key challenges, which is that little blue curve there at the bottom, is for most businesses, particularly SMEs, the average cash cushion is about 27 days. And if an insurance policy pays you at the end of 3 months, then of course you have an issue. Next slide. Now, if we look at this quote from Greg, the CEO of Aon, you really are there thinking, well, now if you want to make a dent in the $26 trillion of intangible assets and the what will probably be about $6 trillion a year losses, declared losses by corporations around the world attributable to cyber. Last year was quite a chunky numbers, but you only have currently between $5 and $8 billion worth of premium. You're not even there in terms of the capacity that's deployed to underwrite. And that's the real opportunity for the segment and for the industry as a whole, is to be able to grow into that. Next slide. So before we go to the answers, I'm going to ask you, whom do you think and what are the potential answer to those issues? And is it slightly tongue-in-cheek? Are we going to hire a PR, release more reserves? Well, actually, tell you what, there's nothing to do because everything is okay. Let's go to the beach. Is it deepen to access to capital markets, or indeed creating new insurance products?
Okay, well, folks, again, off we go. You've had a small hint that it's definitely not number one, hire better PR. And I can see well over half the audience have voted. As ever, Henri, it's a very fast crowd out here. I'm just going to close the poll then and show you the results. So, access to capital or create new products, overwhelmingly there. Back to you, Henri.
Fantastic. Thank you very much. Well, you've already made my day. Thank you for the answers. I love it. So if we now move to the next slide, well, where is the deep market for risk? All the other volatilities, currencies, interest rates, and commodities have one, but risk doesn't have one. So, well, how do we enable that? So next slide. Well, we're already working on standardizing and simplifying. So if you look at the traditional indemnity policies, currently a corporate will buy anything between 50 to 200 policies a year, and go and ask their brokers to guarantee no gaps and no overlap, and good luck, I think, is the way to look at it. So by having a new type of simpler policy that looks at the corporation not as a stovepipe set of different risks, but historically at what they've done, and you can then go to the client and say, what if I could offer you 15, 20% savings on your premium? But because there's some degree of standardization on the capital side, what you also have is a better way to allocate the capital, and therefore there's an increased capital efficiency. And so that's a very compelling way. But for today, really, it's all about parametric insurance. So let's move on to the next slide. Now, indemnity, if you think about it, and it's fair enough because it's their capital. The wording of the policy typically is to protect the exposure of the insurer or the reinsurer, and for them to understand how much are they on the hook for if things go badly, and then to optimize and make money. Parametric insurance is really there to be able to decouple that and say, look, there is a trigger. So the amount of rain, my cellar has a meter of water in it, or 3 feet, or whatever it might be, whatever metrics. But in essence, is to have a lighthouse that everybody can look at, the buyer and the seller, and say that when that particular temperature is reached or something else has happened, there's a trigger that therefore pays me. And of course, at that point in time, there's something called basis risk that creeps in. But of course, the other side of that is basis chance. And when that index of parameters has been reached, then of course it pays out. And then one of the items to note on this slide is, of course, traditional insurance is only in insurance form contract format, but of course parametric solutions can be done in insurance and derivatives. Next slide. So if we then compare the two, and this is a useful slide from TransRe, the key item to note in there are it pays quickly versus traditional insurance where you need to do the loss adjustment process and check that the loss was actually incurred. And of course, because once the index has been selected or the trigger has been selected, it's essentially a third-party trigger, and that trigger therefore leads to a much lower moral hazard incurred. So you're not going to say, well, actually my thing broke, please pay me. You have that third-party check. But as is often the case, basis risk creeps in, and that really is the difference between the index measurement does not necessarily match the insured's actual losses. And of course, if you then have an index like a wind index, which monitors wind 5 miles away from where you live, and your roof has been off, but the anemometer is saying that there was no wind, then clearly you have a problem because you've incurred a loss. Conversely, if the anemometer measures something very high and your roof is still on, then you have basis chance. So closing the gap is quite important. Next slide. And if we look at parametric insurance, and this is a slide from SCORE, it's already used in a lot of different sectors. So you can really create a portfolio of decorrelated risk and be able to write business at scale. Next slide. And that actually is being seen across multitude of segments. Typically, parametric insurance is only understood and seen as essentially as something for catastrophes, but that is no longer the case. As you can see here, there are a number of players across from micro insurance, SMEs, all the way up to microscopic catastrophes. And that is really because you have more models appearing, but critically, and we'll make a difference a little bit later on, you have actually far more sources of relevant data which close that basis risk very, very clearly. So models and data are very important. So if we look at the next slide, we'll look at what we've learned so far. Well, the first thing is that basis risk can be managed, and the product design and the selection of the index, of course, therefore, is important. The second thing is more data, please, with a big exclamation mark at the back, particularly those which are very close to where the risk actually lies. And it's no surprise to know that Aon, for instance, last week reported a strong increase in demand for parametric insurance. It is a simpler product, it is an understandable product, and it is something that you can essentially deploy with clients at scale. And of course, the scope of deployment to clients is way beyond now what it used to be, which was natural catastrophe. You can do contingent business interruption, so CBI there on the slide, and that offers you a path to more market depth, so more market interest, but also more depth of markets with liquidity. Next slide. So as we transition to the last part of the presentation, which is really about data, here's the last poll for you to answer and help me to guide me to see whether or not I'm on the right wicket for the last part of the presentation.
We've had a few comments about what's impeding the market or how could it grow faster. So folks, again, your thoughts on what do you think is the best way to accelerate parametric insurance as well as closing basis risk? Right. Over half the audience have voted in under 12 seconds. That's pretty impressive, folks. Almost the entire audience has voted, and yep, we're up there. I'll now close the poll. So data being very much the heart of it, but fairly even spread otherwise. So back to you, Henri.
Thank you very much. So thank you all again. So if we go to the next slide, this is actually data from AWS. And of course, AWS is all about data lakes, which is I have a ton of data, I analyze them in real time. But actually, this is really important because people will say, particularly for parametric insurance, people will say that a model, of course, is important. And you can try to do a deterministic model, analyze everything from the ground up and hope that you can basically have a right answer. The challenge very often is when you take that is by the time you've got the model, it's too late and the world has moved on. And therefore you find yourself with always looking at what happened yesterday as opposed to what you would want to look at, which is what happens tomorrow. And so having the right data to be able to get the information that is needed in a world that is more with more dynamic risk is important. If you wanted to underwrite, for instance, let's say the spurious example, restaurant today, looking at the last 50 years worth of data to say whether it's a good or bad risk would be interesting, but probably not that useful. But having the information on, is there footfall around the restaurant today because there's lockdown? Are they able, is there credit card activity in the restaurants around, i.e. Are people buying and then essentially they're having takeaway? The intent of people going out to restaurant with Google intent data and open table information on the actual bookings would be far more useful. So next slide. So I'll try to walk you through this chart. So let's take that example of on the bottom left-hand side. And in this particular instance, I'll use cyber. So let's say that I'm a small business. I'm being monitored. Let's say, is my website up or down? And as a result, am I able to do some transactions? So there's a way to essentially monitor that. But so that's the incoming ability to do work. But also I can monitor in real time the cards. Credit card activity in your business. That allows me to create, let's call it a micro index. Now, the carriers today, as we saw earlier for cyber risk, only address probably 1 or 2% of the real challenge. So there's a huge amount of room to grow in there. So you have lots of clients who basically are either uninsured and are looking for insurance, or uninsured and blissfully unaware that they have a massive exposure. So today the carrier will, of course, which is the yellow bar at the bottom, will go to the reinsurer throughout the annual or 6 monthly renewal process with the reinsurers. The reinsurers aggregate that risk. And of course, the reinsurers are scratching their heads thinking, well, yes, but if I've got $5 or $6 billion worth of cyber risk on my books, if it aggregates really badly, then I need to have a bigger friend. And the bigger friend, of course, is capital markets. But capital markets, of course, are going to deploy some capital without having some information and also without having some liquidity. And this is certainly where AkinovA comes in. But if you look at the macro indices, it's an aggregation of the micro indices for, let's say, the segment of restaurant. Total insurable value of a restaurant in Leicester, where I live, is interesting, but actually having all the restaurants around the UK and the US gives you a total insurable value of meaningful size. And that really is far more important in terms of what you really want to achieve. And so that allows the capital to be able to look at those macro indices and be able to say whether or not they're interested as a whole in all these restaurants in the UK and in the US. And also in real time, it allows them to tell them whether or not something happens. And of course, different businesses will respond to different issues in different geographies differently. And the beauty from a cyber risk standpoint, so even so we did some cloud products with Hiscox and Guy Carpenter last year. If you look at the way, for instance, cloud, where we talk about what if the cloud falls over? The reality is the cloud doesn't fall over in one shot. It is organized by zones with different vendors. And therefore, you have actually also a way to create a portfolio. And that requires the data, which are monitoring those cloud architectures, but also to monitor the businesses. And in that way, you can go from micro index to macro index. You can go from a very small amount of total insurable value, where the client is being looked after by the carriers in a normal way, but you can add some capacity in concert with the reinsurers to be able to underwrite more. Next slide. And let's take an example, of course, which is close to our heart, which is called the reinsurance business, the insurance business in the world of the pandemic. If I now monitor the same restaurant, and I have an ability to monitor the card activity in the zip code or in the postcode right around that business, to have a bit more of a sample than just a sample of one. Clearly, if you have a bad chef in the restaurant and your restaurant is down because of that, you want to monitor that versus a few other restaurants in the same areas. And that card activity can be monitored across multitudes of geographies and aggregated into the same macro index that you have on the top right-hand side. Then you can also, from a capital market standpoint, look at whether it's aerospace, whether it's a restaurant, whether it's entertainment, or whatever it might be, hotels and others. Now, of course, for an insurer, for the insurer, the business, I want to be paid quickly. So you can create a double trigger if the local official says, well, actually, there is lockdown, and on top of that, your bookings, and on top of that, your actual takings are down as measured in real time by, let's say, more than 75%. You have a payout. You don't have to wait for 3 months to actually verify and do the forensics accounting. Now, of course, that goes into as gross written premium into the insurer or the reinsurer. And they, of course, would like to make sure that as they grow their business, they don't accumulate the risks. And of course, as we know in pandemics, the critical issue, whether you call it pandemic re or any recovery re or any other acronym that you would want to think of it, is there needs to be some sort of government backing. But by putting this structure in place, you can put the government backing more remote from the underlying risk by having a slice of this being taken by insurance and by capital markets. And secondly, you can also have an industry which tends to ask questions from the businesses that they provide insurance cover for, and therefore raises the game in terms of risk management for those businesses. So you actually have an industry that was designed to actually do risk transfer to actually help the clients themselves. And so in that way, you can create capacity which is needed and not just go through the banking sector as was done throughout the pandemic to make businesses whole through lending structure. And then the final thing, of course, is the repayment is done through premium as opposed to taxation or other methods that we will see over the next few years. So with that, I will conclude and go to the next slide, and then we'll move to the Q&A. Thank you.
Well, absolutely super, Henri, and frankly, the board is lit up with questions, so we'll get cracking if we can. You ended in your last two slides on the role of capital, and Charles Vermont is curious, who will you get to risk their capital when there is as yet no evidence that the insurance or reinsurance models are working accurately, particularly for some new classes?
So I think those who are far closer to the actual data. So there are several ways of modeling a risk. You can basically say, I'm going to, from the ground up, take all the various risks, aggregate them in a big model, run the model, and tell you what the expected loss and so forth. And of course, that's needed. But actually, if you have an index, so think of VIX. VIX is an aggregation of an underlying set of data coming from a variety of parties. And then it allows people to trade contracts based on VIX only. Now, I'm not saying that you need to have exactly the same thing for insurance or reinsurance, but in essence, if you have a way of tracking the risks that you're going against, and you have a way to create that index, let's come back to, for instance, a credit card activity in a zip code, which is totally doable today, and you can monitor that in real time. I can tell you, you can do some really interesting things with that. You don't need to model anything. All you need to have is 5 years of data for a particular geography, and you can monitor in real time, for instance, a hurricane in Florida. You can see people going to shops, the activity goes up. Then when the hurricane is there and you have a shelter in home, or you basically have please leave, then you see no economic activity in the area. And then if there's no economic activity in the area for the following week, I can tell you usually it's because there's a huge amount of damage. So immediately you can create some products. And then the more granular the data you have, I mean, you can monitor literally down to the one business all the way up to the local zip code, which is typically a little bit better. You can create some products which immediately gives you comfort because these are companies providing the data, which have, some people would say, more data than God. I'm not quite sure that's true, but they certainly have a ton of data, and those data can be summarized in an index, and you can trade off that.
Well, the audience has certainly picked up very strongly on the data point. Trevor Hilder makes an interesting point that in order to obtain data, you have to have a model. Otherwise, the data is meaningless. And you do have a model, even if you don't know it. You do have these sort of implicit models in mind. He also ponders whether or not you want to be writing these types of policies as a distributed ledger technology, smart contract or something. But I'd like to move, if I could, onto a point about the data that Bob McDowell makes. Do these indices require some form of regulation or independent oversight? And we did, of course, you'll know, Henri, we had discussions 6 or 7 years ago with ESMA trying to bring various indices, largely motivated by the LIBOR scandals, but to bring these indices into regulation on the capital market side. What about the insurance side?
I think you need, it is important not to introduce moral hazard through the index. A good index is one that will, particularly for parametric insurance, be close enough to the risk so you don't have a massive basis risk or basis chance. But on the other side, that there's a third party umpire. So some of the trades that we've seen and performed, there is a third party umpire that monitors the index and is neither the broker, the buyer, or the seller. It's a true third party that basically says the event happened or didn't. And the quality of the underlying.
Could you name a firm or two that do this?
So yes, so if you think, for instance, that PCS, a division of Verisk, do that. Some law firms do that as well. So they look basically at the index and say whether it happened or not, particularly when you're very close to a trigger to say whether or not it happened or not. And then mostly it is also important for the capital market players to have typically 3 to 5 years worth of history, because then you can understand, you create your own model of what the index, how it behaves. And then the final piece is that they should be a recipe to say how the index was created. Black boxes typically are more challenging for capital to want to play. What they want to be, typically they don't want to recreate it. What they want is an institution that will be there for the long term, with a clear way, the way the index was created. So for instance, if you look at some indices for mortgages and so forth in the UK, have been going around for 20 to 40 years. And it's very clear how they're assembled. Typically, they end up by being with a firm like IHS Markit or otherwise.
You closed with cyber as sort of an example, and Madhu Acharya is curious, what's the possibility of parametric insurance for large-scale cyber risk? Is it imminent, or is it going to take another 5 or 10 years, as you indicated, to build up the data?
So we already had the privilege of performing some of those with Hiscox and Guy Carpenter and others over the last 12, 13 months. So the indices exist. If you know where to look, there are typically government agencies which have been reporting certain standards for the last 5 to 15 years. So you have actually good data available there. So you can create trigger events. So cloud, for instance, we've done cloud coverage. As I said earlier, people tend to think of some sort of doom scenario that the whole cloud falls over. Typically, if the whole cloud falls over, it's because there's no power, no cloud, no internet usually. But cloud is organized by regions, by different vendors, and so you can create a diversified portfolio. We've done cyber hacking of power generation of the grid in the US, of government index. And then, of course, as you well know, Michael also has an index monitoring website, which allows you to have a trigger event more for the insured, the SMEs, for instance, and be able to create a product there. So I think the products are there. I think what you need to get is that comfort that this can be meaningful, and that through diversification, like any portfolio of risk, at the start, the rate of return that you expect on one risk is much higher than once you've got a portfolio of diversified risk. So the challenge is not really the indices nor the actual policies themselves, is how do you start as a capital provider that you don't ask for 20% return and the client expects to pay only 2% rate online for their insurance policy.
You mentioned moral hazard quite rightly in this context. Ian Harris says, comparing parametric insurance with clubs and mutuals, in my mind, clubs and mutual approaches reduce moral hazard and promote good practice through the club rules. How do you manage moral hazard and encourage good practice in a parametric insurance model?
So a parametric assumes that the rules of the game have been defined at the start, i.e., if you play a tennis match and the ball is out the court, then clearly you basically lost that particular point. What you can't say is, well, yes, but the wording was saying that if a hair of the ball appears to be touching the line, which is what you have in indemnity, and then therefore that's why you pay umpires for, to actually be able, and then you have eagle eyes and electronics to be able to tell you if it was in and out. But in essence, parametric, with the right selection of the parameter, allows you to have a very low moral hazard, because rules have been defined at the start, and it's really look at the index, say, was it 55 or 56? And if 56, you you have a payout. If it's 55, you don't. And so the moral hazard is much lower. The key is in the advice that you have in the conversation we have with the client. So you do need someone to help that, no different to any insurance policy, to tell you, right, if I now have a flood measuring gauge which is 25 miles away on a hill from you, and you're right next to a river, I mean, you don't need to be a rocket scientist to work out that your risk is much higher than what the index would tell you. So being able to bring the index close to where you are and having the trigger for something that's meaningful to you is important. But in that way, you've closed the moral hazard.
We've got quite a few climate change related questions. I'm going to try and bundle them up because I've got quite a few questions to go as well. So Andrew Ross is curious about how will this apply to climate change as a systemic risk, perhaps valuing regional insurance investment in municipal bonds. Got a question really from Mike Clark, which I think is probably the one I'd like you to answer, which is Her Majesty Treasury's net zero review focuses on mitigation and excludes the cost of climate adaptation. So we citizens and companies bear those risks, not the state. What's your solution? Is it very much in this space? And I'll leave it at that if I can.
Sure. I think the challenge is in that particular space is that very often, yes, there are big gathering COP20, and basically people gathering, getting together, and essentially getting solutions which are trying to transfer risk from one place to another. But it's really point to point still at this point. What I think is missing is the aggregation of all these various players on an environment where they can basically trade some more standardized products and therefore create a risk diversification more globally, but not exclusively at the balance sheet level of an insurer or reinsurer, which is very specific to them, but more an ability to transfer the risk between governments more than the process in an easier way than the process that there is now. So let me give you an example. If you have a certain set of temperatures, what's the impacts on securities? So the investment side of the insurance companies is interesting, but actually, what's the impact on the country to another country? Indonesia versus, for instance, the UK. It's always point-to-point activity. It should be really concentrated in one area to give more depth and more diversification for investors.
Okay. So there are a couple of questions here. Mike Clark touches on what's the role of the state versus some kind of central risk organization, government. Bob McDowell is curious about the role you think government should play, if any, as catalyst to growth of the insurance market. So there's a lot of people curious about what you think government might do to help the sector grow. But I think I'd just like to touch on Alan Punter, who congratulates you on a great presentation. He says, I believe completely in the theory of parametric insurance, but what are the main impediments to further development? So adding government in, is it demand? Corporate buyers should value prompt cash settlement. Is it supply? Can parametric products fit into existing taxation, regulatory, reinsurance, and other environments? So what are the impediments, and is government related to them?
So I'll start by the impediments. When there's something new and it's a financial product, you need to have people who know how to sell the financial product to and sell it properly, of course, no mis-selling. To the end client who are insureds. And that is one element of the equation. In insurance, no premium, no business. And of course, no capacity, no underwriting. So I'll always start from where's the cash and of course is where's the premium. So I think there's an element of that is brokers, because of history, of course, are more used to sell indemnity products. And therefore there is, and then of course there's that comfort that you go to a client and say, please sign this piece of paper here and tell you what, most of the problems have gone away. And then of course, when there's an issue, he's my lawyer if I want to over-egg the pudding to make the point there. In parametric, you need to think a little bit as to what index is going to be moving the dial. So there's a bit of advisory. The second piece I would say is better data. Yes, models, as I said, are important, but actually better data with history, which allow you to create a view of a trigger that you know how the trigger would behave. And then the third point from a capital standpoint is, of course, is having the history. Who wants to be the first dollar to underwrite a piece of capacity if you are the first one to potentially have a loss or have a gain? So there's a certain element of having the right risk-reward equation for the investors. And if I look at the final piece, which is what's the government's role, so for instance, the growth of cyber, Michael, you mentioned just before, if you look, for instance, at the governments and the institutions in the US, which is also moving in the same direction in the UK, for banks and banking-related institution, there is now a requirement within a very short amount of hours for, and that requirement is potentially going to law for a major cyber hack to be immediately disclosed as a disclosable item to investors, as opposed to I'll go and solve the problem and I might tell you in 3 months' time what happened. And there is actually evidence. There was a paper research that was done over the last few weeks, which actually shows that on some of the major hacks, there was insider trading with options and derivative to try to mask the activity before the hack was actually disclosed to the institution. So governments and regulators to actually say you need to put your best foot forward, which then forces immediately the quick payment, then drives essentially a simple product like Parametrics.
Actually, Henri, that comes really nicely with two items. The first is that we've seen, and you emphasized in the warm-up call, that it's the need really to make sure that the data really fits the situation that you face, because it's a general index, and how does it relate to you? You've got the investor, of course, wanting the index to suit their investment profile, and this leads potentially to data gaps. But what you just touched on is something where Mike Clark is kind of interested, is your view, for example, on the FCA-led litigation regarding policy wording and COVID risk insurer liability on pandemics. So, is this an area where government is likely to come in and effectively post hoc make sure that coverage is there, even if it wasn't what was intended at the time? So what does that mean for parametric insurance?
So if I start from one of the pieces during the presentation, which shows that the average, the cash buffer of most SMEs is 27 days. And the tail end of that is 60 odd days. So it's not a huge amount. So being parametric and saying if the local official says you're closed and your degree of turnover is more than 75% than what it used to be on average the last 5 years, and then I compare that with the, let's say, the local postcode to limit any effects due to specific your businesses, like maybe someone drilled a massive hole in front of the office and you can't get in, then allows you to do non-physical damage business interruption with a very quick payment. Now, the way government, I would suspect, is going to go about this is the insurance industry and reinsurance industry has not offered really solutions. The solutions which were there before the pandemic turned up, nobody was buying them. And now there's a whole queue, lots of demand, but not enough capital, as is always the case, right? So the point now is to create a solution for the future. What we believe is that it's going to be parametric for the businesses because it pays quickly. You have a wealth of data to say whether or not there was some gaming in the system or not. You'll have an increase of the risk awareness of these small businesses. And on the other side, the government is probably not going to force people to pay because that would be looked as a tax, but potentially say if you haven't bought into that cheap insurance, then good luck. But we don't force you. But if you do buy it, then of course you're part of that program with government backing.
And the last one, and I'm afraid time will have to be brief, but Bob McDowell, and Bob's dialing in from the Channel Islands, so he has an interest and knowledge of this. How would you position the growth of both self-insurance and captive insurance in your proposition for parametric insurance?
I think they're very important. Captives typically are very conservative. But we're certainly already working with captives who basically have had enough of having some complicated policies and also need to be able to reduce the amount of capital that they have in their captives. And having a solution to trade arm's length with other firms with similar risks but in different geographies, I think is highly attractive with simple wording. So there are clear triggers. And that allows all the captives to reduce the capital intensity in their reserving because essentially they can transfer and create a market with other captives and insurers and reinsurers, of course, are additional capacity.
Great. Well, Henri, it's been a very vibrant presentation, and it's not exactly been the largest of audiences, although quite sizable. But more interestingly, it's generated so much interest amongst the audience, and I will be passing on to you the comments and questions so you can get back to people individually if you like. As mentioned before, folks, things will be online quite soon. If you'll just bear with me, I've really got three rounds of thanks to do. My first round of thanks is very, very much to our sponsors, who are extremely kind in letting us range widely and freely across, as I say, technology, economics, and finance. And today, Henri has really brought a financial perspective and an economic perspective, but also applying this to technical risks such as cyber is certainly a real possibility. I'd like to thank you, the audience. You've been super today, very much leading our presenter down paths. He definitely wanted to go down anyway. And I'd like to thank you very much for listening and remind you of the forthcoming events in the following week. We've got a session tomorrow on digital identity, very intriguing. MasterCard's new look at effectively global private identity and services that they're providing in that space. As ever, everything else is on the website. Henri, I'm afraid in these days of COVID and lockdown, I'm unable to open the floodgates of applause, but I can tell it was out there. I could tell it was out there just in the way that people snapped up your poll questions. But I have brought my Korean karmic clapper, which is my device for providing you with audience applause. And I'd like to thank you very much for your contribution today, and we hope to stay in touch.